Well, from oil wells to credit warnings, two stories, one global undercurrent, uncertainty. As OPEC weighs a bold production hike that could shake oil markets, the US is facing a credit downgrade from Moody's, spotlighting growing concerns over debt and fiscal discipline. What do these mean for economies like Nigeria's, caught between revenue from oil and exposure to global financial sentiment? Let's unpack it all with Dr. Ifeanyi Ubah, Head of Investment Research at Commercial Partners Limited. Great to see you.
Thank you.
So do you want to start with OPEC or do you want to start with the US?
Well, let's start with OPEC because it hits us at a very soft
Yes, it does.
Right? I think the budget was for 75 and right now oil is trading around 60. So the point is that OPEC has flipped this script, right? They have made friendly bodies with Donald Trump, who wants energy costs to go down. And they're also trying to checkmate rebel members that are increasing oil output. So this means that they are no more focused on the price and they might now still be focused on the output. But there's still the meeting to be had and there might be shift in consensus, right? But from what all indications, people are actually looking at a bearish signal for oil.
So I mean, you almost talk about OPEC as if Nigeria is not part of OPEC and part of the decision making. I don't know how much leverage the actual oil exporters have, but you know, US influencing OPEC, how realistic is that, given that there's been a bit of a severance in that relationship for quite a while?
Yeah, so so we know that there is definitely a severance in that relationship, but the major thing is that the OPEC has to, as an oligopoly, you could only choose price and output. And people like Saudi Arabia could probably pump in their output.
Of course.
But Nigeria is at a dilemma because even their output, even if they increase it, we might struggle to reach it because of our homegrown bottlenecks, right? So there's a problem, and so the negotiation power that Nigeria brings to the table is kind of minute. We are really hoping for the oil price to go as high as possible so that no matter the quantity we produce, we'll be able to generate enough revenue. But the way things are going, we have moved from a place of globalization that looks at integration to deglobalization. Everybody's trying to save their neck in this growing time.
Yeah, interesting. And so OPEC is thinking of releasing an additional 400,000 barrels a day in July. If you recall, some years back, it had held back about 2.2 million barrels a day from oil markets. So beyond that 400,000 barrels, do you see it kind of releasing the full spectrum of barrels?
So if I was reading Bloomberg and most of the analysts said it's more or less like a band-aid. If you really want to do this, you just have to rip it off. So if they really want to get the necessary action, they will need to just increase this. But if they don't, we still see the intrinsic value of oil around $80. But this price is controlled by the oligopoly, depending on what they agree on the supply.
Yeah, and of course, Iran is also thinking of pumping up more crude. Iraq. I mean, there's so many drivers that could actually influence the OPEC, the cohesive, collective strategy of the body. But the U.S. downgrade, Moody's has downgraded the U.S. Of course, there's this whole tax bill in the U.S. legislature. The U.S. has about $36 trillion of debt overall, a lot of which is held by maybe 4 or 5 big economies around the world. Tell us what the impact of the US's debt situation is. I mean, most of the market is kind of ignoring the Moody's downgrade, which they typically have done. But what is significant about it this time around? Right.
So Moody's is the last official rating agency to downgrade them, right? But why it's really significant? Because it has a cascading effect. We saw the 30-year yield push above 5.1%, and the 10-year yield is flirting with 5%. It's around 4.6. It hit as high as 4.8 in February. So one thing that happens is that if we get the 10-year yield to as high as 5%, we could see an emergency rate cut because it will mean trouble for the United States. Their debt to GDP, is projected to be 130. It's currently 98%. So we are looking at gobbling almost 30% of revenue by 2030. So it has a cascading effect. We know that the United States is a hegemony, but when hegemony falls, there are no announcements. People sip teas and ignore the warning signs, and the rating agencies are actually giving fair warning signs, talking about the people that buy the United States debt. Japan is having a debt crisis right now, and they are the largest creditors to United States. So this cascading effect can ripple down to even Nigeria when they are coming to tap into the Eurobond market. The last time they did 9-10%. Now the investors will be looking at higher appetite.
Higher than that, yeah.
So we might see Nigeria that wanted to fund their revenue by a $75 oil come down to the investment market, and if you don't have the high oil price, you must need to give us high interest rates. So you see Nigeria even issue maybe more domestic bonds in order to fund this budget.
Yeah, and interestingly, when we look at U.S. monetary policy, what the Fed is doing, Trump has obviously clashed with Fed Chair Powell, and his strategy has been to try and get the Feds to reduce rates, really, and used all sorts of political tools to try and get that happening. What do you see the trajectory for U.S. monetary policy as being in light of this debt crisis?
So like I said, we saw the 10-year yield hit around 4.8%, and Powell was not shocked. So he's actually facing what we call a stagflation. Yeah. And during a stagflation, we see U.S. monetary policy cascade, right? So stagflation led to the drop of the gold standard. We had another stagflation that brought down the Vulcan effect. So if we see a recessive period, we already have a negative growth rate. If we see another negative growth rate calling a recession, or we see the bond prices move to that 5% threshold, it could force the hand of Powell. And if I know Trump likes to force the hand of people because the talks of China and the pause is having less effect on the market. So there's nothing he could do from the physical side. And if he really wants to make the rates go down, he might just wait for things to get bad before it gets good.
Let's talk about CBN. The rate pause, 27.5. What does that signal to you?
Well, that was the only move the CBN could actually do. He's actually still facing challenges in terms of the stability of the Naira and keeping inflation at bay. We see inflation still trending downwards in terms of food prices, but core, which removes energy prices, is actually still stubborn. So and remember, we still need to have high rates to attract foreign investors. So that was the only move he had, and in fact, there was a consensus that he would keep rates steady. So we see major emerging market currencies actually gain against the Naira because even the DXY is trending downwards like Donald Trump wanted to do. But we don't see that much gain from the Naira itself on month-on-month basis when you're comparing it with the US dollar compared to emerging markets. Commercial Partners actually released a report on this in detail, comparing Nigeria to other emerging countries. So we see other emerging countries actually gain from this loss of the dollar strength, but Nigeria
doesn't seem to have been gaining. That's very interesting.
Yeah, but we are not collapsing either. So it's kind of like if it's safe haven, and reducing rates right now will actually give more pressure to our currency and maybe uptick the inflation. So this was the best move for the president.
Yeah, indeed, the best move. Let's talk a bit about that food inflation, because for months, successively, food inflation was a major challenge. Now we're seeing a moderating of food inflation. Is there anything structurally or in the wider economy to point to why we're seeing that food inflation moderation? Is this going to be a trend in the next few months? What can we point to say, this is why?
So it's like you have to take it from a macro scale, right? So food inflation has been trending downwards, and we majorly account the food inflation has a little bit of imported inflation to it too. So, but that phase of the devaluation of our Naira has passed. And like I said, if you're comparing any inflation figure to a point where there was economic imbalance or a devaluation, you probably see a good figure. So compared to where we were when we were around 500, then we went to 1,000 Naira, those effects are no longer happening. We will also see it in rent. Your landlord is not going to tell you he's going to increase prices right now. So things are definitely trickling down, which is in line with our macroeconomic projections.
Yeah, and the CBN governor also cited this decision to the narrowing of the exchange rate gap. Can you talk through some of the trends we've seen in that regard between the parallel market and the official market?
Oh yes, we have definitely seen a trend of narrowing, right? So we see it collapse, but we still need to checkmate it, right? We need to look at the long-term effect and the overall. In fact, I can't talk too much in this because most of my analysts are actually preparing a solid report that will come out by May, examining how the CBN has actually dealt with the exchange rate and the advice we have been getting from foreign policies. We see the World Bank release their report, the IMF released their report, but there's something structural about this that in-house we are thinking about it in a different way.
Okay, and you can give us a hint of what the structural secret is.
What I can say is that remember SAP, the structural adjustment program that took Nigeria from one trajectory to another. And it started with one word, devaluation of your currency.
Yes, of course. And in some ways, you know, if I look at some of the programs, some of the multilateral institutions are sort of pursuing other countries, you always get hints of the structural adjustment ethos, which is foreign exchange liberalization. But foreign exchange liberalization is slightly different from devaluation. It's like two ends of the same continuum. Exactly. Okay, so you've given us a hint there. We certainly would want to explore it in the future. But in terms of the next MPC meeting, right, what do you think the likely move is based on the trends you see today?
He still has to hold it.
Hold?
Definitely, because he can't increase it, and reducing it will still mean structural challenges too.
Okay.
So he still has to hold it. Remember, we still need to attract foreign investors.
Indeed. And of course, we also need to think in the context of global monetary policy, because our monetary policy moves may also be influenced by what happens elsewhere due to the way capital flows are so dynamic these days. Thank you, Dr. Ifeanyi Ubah. Always great speaking to you. That was Ifeanyi Ubah, Head of Investment Research at Commercial Partners.